walkability to restaurants, connections to hotels, amenities. That's what's driving the successful office projects. So I think as communities think about what works, it has to be about maybe it's a little bit of everything, and it's about how all these pieces of the puzzle kind of fit together.
Welcome to the DuPage Business Beat, a podcast about today's biggest business issues told from a Chicagoland perspective. Hello, Chicagoland. Welcome to the DuPage Business Beat. I'm Greg Bedalov, President and CEO of Choose DuPage, and the host of today's podcast. Today, we're talking real estate again. What are the latest trends? How's the Chicagoland and DuPage County market evolving? And what do you, our listeners, need to know? To help me unpack those questions, I'm joined here in the studio at the College of DuPage by Jim Adler and Mark Moran, Executive Vice Presidents of the Oak Brook Terrace-based brokerage firm NAI Hiffman. If their name sounds familiar, it's probably because they were my very first guests when we launched this podcast some 15 months ago. So, Mark and Jim, welcome back.
Thank you. Thanks for having us back.
Yeah, appreciate it.
So I have a few trends and data points that I want to cover during our conversation, obviously. But first, let's start with a very general question. What's going on in the real estate market? What's caught your eye? Jim, let's start with you. What are you seeing? I know you do a lot of work in the office space.
Yeah, the office sector, it's really been more of the same from what I can tell. Obviously, we had a huge increase in interest rates since we last talked, and that has put a lot of building owners in a challenging position where, some of them, quite frankly, were unable to finance doing transactions. So that's put a little bit of a kink in the office market. We've seen more of the same in terms of companies downsizing, going from 20,000 square feet to 6,000 square feet, shrinking their footprints. The flexible workspace operation has continued. So I think, it's been, from our perspective, a little bit of more of the same as we expected. The one thing that I will say that we have seen is some of these, what we refer to as zombie offices, start to begin to be redeveloped and rethought of and repurposed, whether that's data center or whether that's residential conversion or industrial. And I think, we all view that as a good thing. We frankly, have the office market has too much inventory, and a lot of us have believed that really since the 2000s, that there's just too much office in the suburban marketplace. And so some of that is starting to go away and be rethought and redeveloped. And I think that's probably needed to bring some balance back to the office market.
But you mentioned interest rates and interest rates ticking up. Some of us, myself included, remember the real estate interest rates of the early 90s hovering around 10, in some cases even north of 10. We know what happened. Everything kind of went real low down to the high 2s and low 3s. And now we seem to be settling back in somewhere 6, somewhere in that neighborhood. There's a group of folks who say, what, you can't make money at 6%? Did the 3% money become addictive to developers, or was it this kind of blip in time that set an unrealistic expectation that everybody got addicted to?
Well, I think the expectation is oftentimes tied to, in the developer's case, and Mark can speak more to that, but how they can exit the property. So if they're investing in at a certain basis, what's their exit become? And when the interest rates go up from the time that you invested in it to the time that you are exiting that property, you can find yourself in a position that's neutral or even upside down. It's also, the other side of it is that there needs to be sight lines to where we're going with it. And I think that's created a lot of pause in our industry where people have said, I'm not going to develop necessarily today. I'm not going to acquire that office building, or I'm not going to acquire that industrial building today. I'm going to wait. And I'm going to wait for the Fed to make a move so that I could have some sight lines. And also a reminder, and sometimes we forget this, we are in an election year. And oftentimes in election years, this happens. And it doesn't really matter who you think is going to win or lose. It's more about, I can see where this is going. And so when you have uncertainty and you don't really know where it's going, you create a marketplace that kind of tends to stand still.
Same trend happening in industrial, Jim?
Same trend on the industrial side. And, as Jim pointed to, it's less about where interest rates are and more about the spread between where they can borrow money and where they can sell the stabilized properties. So obviously lease rate comes into play there, but to Jim's point, uncertainty is particularly an issue on the industrial side as well. So we have not seen any significant new speculative industrial development over the last 2-3 years because of those very reasons. So
is industrial development spreading out farther and wider now, though? Because as I look around DuPage, for instance, largely mature county, the business park out in West Chicago going from 1 or 2 buildings out there to now 1 or 2 pieces of property even left for development. There's clearly a need with transportation, distribution, logistics, data centers, the things that you pointed out for continued growth. Is that just kind of shifting west and north or south, or or is it just more specific?
Historically, it has shifted out where land is more plentiful, but I would say that based on what we just discussed, developers are even less inclined to go further out right now because that pushes them out on the risk spectrum. So if they're going to develop an industrial building right now, particularly on a speculative basis, the only things that we're seeing built speculatively is if it's a infill market with a strong track record so that they can sell their investors as to why they're doing it. So short term, developers are very hesitant to do anything. Long term, yes, they're going to have to push out further because there's no land. So it's either going to be redevelopment further in and infill locations, or pushing out further, west, north, wherever land is available.
Where do the major players from a distribution perspective or a warehousing perspective, the Amazons of the world and the big logistics companies, where do they fit in this discussion?
What we have seen, when we met last, we were at the tail end of the pandemic. Companies, particularly third-party logistics companies who warehouse for all the large consumer product companies, they were taking space as quickly as possible. And a lot of that had to do with the fact that the supply chains were so screwed up coming from Asia that they had to get as much product over to the United States as they could. So as a result, they're taking down huge chunks of space. You're seeing large transactions. That's changed now that the supply chain has been, for all intents and purposes, back to normal. What you've seen is a lot of these companies had too much inventory. So we saw we don't need as much space now. You saw some sublease space come back on the market. And, that also shifted, to your point, to do we need these huge distribution centers, million square foot distribution centers? And I think a lot of companies, including Amazon, are saying, we need to be closer to our consumer base. So, we're gonna take these distribution centers from 1 million square feet and maybe we do 300,000 square foot buildings and put them in strategic locations. So we have seen that. I think that will continue, and that will require redevelopment in infill areas, because obviously you can't be close to a population base and find a site to build a new building. So
I heard you say redevelopment twice, and I've often talked about how economic development in DuPage is becoming economic redevelopment. And last time we got together, we talked about the role that municipalities and entitlement processes play in this, and zoning and master plans and comprehensive strategic plans for villages. I'm hearing you guys saying that once again, we are continuing in a change mode where office buildings, the demand just isn't there. The big 1 million square feet distribution centers, the demand for that isn't there, but it's becoming infill and repurposing. What are you hearing on the street from municipalities in terms of their reluctance or their embracing of kind of new ways to skin that cat and position themselves for continued growth?
Well, I think I just saw that Naperville put out an RFP for both the Nokia site and the BP site to get some input as to what they should see there as future development. So that's a good test case of a municipality saying, all right, we need to figure this out. I think they've been pretty clear they don't want industrial. So what does that look like? And I think that's seemingly the struggle a lot of these municipalities are continue to have, which is what we talked about last time. And I don't think it's been solved since we talked 15 months ago.
What about from the office perspective, Jim? I hear more and more live, work, play, multifamily seems to continue to be a growth market. What are you seeing at the municipal level or the county level or the regional level in terms of, let's look at the office building. Chicago did it on LaSalle Street where they tiffed the old storied financial headquarters buildings and said, we're good with apartments here, and we want to start attracting businesses into these residents into these central business districts. You seeing any of that kind of stuff in the burbs?
Not to that extent. I do think the burbs, there is some of these municipalities. I reference Oak Brook. They like data centers in certain locations. There's good tax revenue from data centers. There's not a huge traffic impact on data centers. There's not truck impact for data centers. So they like that use. The one thing that I would have a little bit of reservation about data centers is that they don't also have people.
Right.
And so that's something that needs to be balanced, right? And as we think about these redevelopments, and these communities think about redevelopment, they need to think about balance. And it's, nobody wants to say, yes, let's just make it industrial because we want 400 trucks in our backyard. But at the same time, as you guys talked about, we also want our packages tomorrow. So there needs to be some balance, and maybe there's a fit for not all industrial, but some of it. And then maybe it's a mixed use that is something that is more attractive. Office users, 100%, are wanting more of a mixed use workplace where there's some walkability to restaurants, connections to hotels, amenities. That's what's driving the successful office projects. So I think as communities think about what works, it has to be about maybe it's a little bit of everything, and it's about how all these pieces of the puzzle kind of fit together. Well, and there's we've seen it in Itasca and to a certain extent Elk Grove. Elk Grove is a big data center hub. And one of the things, just as a reference point, Chicago, I think, is the third largest home of data centers in the country.
Right.
And so as we look at, and we also have the advantage in the suburbs is that a lot of that real estate is in the suburbs. It's just easier to locate. Chicagoland region makes a lot of sense. We have the resources, we have the water, we have the power. We don't have hurricanes, we don't have earthquakes. So it's a good place to make that investment. And we're seeing successful data center developments in Elk Grove and Northwest Point, where two office towers that we probably thought would never come down have come down because they were a data center developer came in. So we've seen successful examples of that where, it definitely it fills a need. And that as an office market is kind of a tweener office market anyway. And so I think that's really a win-win for that Hamilton group in Itasca, as well as at Elk Grove on Northwest Point, to redevelop those offices as data centers.
So you guys obviously know about the quantum space and the PsiQuantum deal that the city of Chicago just announced in conjunction with the governor. Choose DuPage was proud to participate in that, and we recognized the value to the region for a deal like that. Let's talk a little bit about that deal. What do you see that deal, Jim, doing just from a economic multiplier, from a spin-off companies, from just a raw development perspective?
Yeah, it's a great question. I think they just had their groundbreaking a few weeks ago. It made the press. It's my understanding it's projected to generate $20 billion in economic development over the next 10 years for Chicagoland, as we like to call it.
Sure.
And so that's exciting. And I think the expectation is that there's going to be numerous chip and semiconductor companies that will want to be in Chicago to be a part of this project.
I mean, they have to be, right? Shameless, sorry for interrupting, but, shameless plug for DuPage in the Chicagoland region. Argonne, Fermi, University of Chicago, Northwestern, Notre Dame, U of I, College of DuPage. Everywhere where the ecosystem demands that type of talent, it's here.
100%. And we've talked about this at our last podcast too. I think there's so much talent here. There's so much intellectual capital that we have in Chicago, in the suburbs. You look at our schools, the hospitals, everybody, the talent that we have here, it's second to none. It really is. And so I think this makes sense for a lot of reasons. The impact, as I look at it, I think it will also impact the office market. We fielded an inquiry just this week from a site selector that said, hey, we need space for a semiconductor company for 150 jobs, and we're looking for office space. And so I think we're just at the very beginning of those companies and those needs. People wanting to be around this development and be a part of this.
Yeah, not everybody who works in a data center, there's still office jobs that are associated with that. There's still management jobs that are associated with that. And my thinking, it just has to spur economic growth. But along the lines of the answer to that question, Jim and Mark, have we turned the corner? Have we made any headway? Have we made any changes about the perception of development in Illinois and Chicago based on water, based on talent, based on schools, based on location, based on infrastructure? Are we making headway? What's the street saying, or is there reluctance looking at Chicago and Chicagoland area?
I don't see reluctance. I think we are making headway. Are we there yet? No. But as I think about our office market, we used to be anchored by these sort of mega users. We had Lucent Technologies, thousands and thousands of jobs in the East-West corridor. We had AT&T, we had Allstate, we had Walgreens, these big pharma companies in the north, and they all shed space since the pandemic or even before, and we were left with a lot of vacant space. And now we're turning the corner where we're out of the pandemic. We're looking at those buildings and we're finding different uses. We've talked a lot about data centers, but it's not just data centers, it's industrial development, it's multifamily, it's rethinking some of these mega office projects. And when you have a win like this quantum computing thing, that's just one more feather in our cap that I think can potentially spur even more creative development. We also just got started in the life sciences development a few years back with some developments in Lincoln Yards and Fulton Market. And although that market has been a little bit depressed as of late, I still think there's a future there for a life sciences presence in Chicagoland. So we have the luxury of being a very diverse economic engine here. And I think just because we had too much office inventory at one point in time doesn't necessarily mean things are bad. In fact, it means I think this is actually a really exciting time where we can look at some of these zombie offices or mega developments and say, hey, there's all these other asset classes where there's huge demand, and it goes from multifamily to quantum computing and data centers. And I think that's very much a part of the conversation in the real estate community these days about talking to developers, talking to users, talking about how we continue to adapt and continue to change. And at the end of the day, in my office world that I live in, it's net positive because we are going to reduce some of that inventory. We are going to get back to a balanced marketplace, which is healthy for everybody.
Sure.
It just means that we have better office opportunities. It means it's going to spur more office development down the line, and we'll get back to
so more office development, because I think every mayor who's listening to our podcast and all the elected officials and the managers want to know if that's going to happen, but everything is being right-sized and people are shrinking their footprint and whatnot, is every Class B and every Class C tenant going to eventually try to migrate to the Class A because of the financial pressure on the Class A and wanting to keep their lights on and all that kind of stuff?
Well, I think we have a long way to go in the office market. We're at in the suburban office market of 110 million square feet. We're 25% vacant. Companies continue to shrink their footprint, at least in the foreseeable future. We see people working a little bit more efficiently. Instead of 190 square feet per person, we're more like 155 square feet per person. And what that means basically is there's less workspace, a smaller office, smaller workstation, more space. So we're going to continue to do deals and we're going to continue to shrink. That vacancy is probably going to continue to stay on the higher end, 25, maybe even 30%. So we have a long ways to go, even with reducing some of that inventory. I do think there's still always a place for the Class B tenant, the Class C tenant. Yes, there's many companies that want to be in nicer buildings and class up. I do think eventually we will get to a place, I don't know when, it could be 5 years, could be 7 or 8 years, where that Class A market will be very full and will actually be back to balance. And for us, balance is maybe 12 to 15%.
That's what it is traditionally back
And then we're in a
10 years
place
ago.
where large companies are saying, "Hey, we need to build another building," and that is a great thing to happen. When we start to get into that mode, we just don't want to be building buildings when we're at 20% vacancy. That's where the problem is.
Sure. And Mark, I promise we'll get back to industrial in a minute, but I want to follow up with a couple of questions for Jim and maybe you on that because it's probably applicable to the industrial world. You mentioned WeSpace, so I think of the Bellworks facility up in Hoffman Estates, and how's that particular property doing? And it's maybe a lead-in to number one, and a bigger, broader question is, now that we're right-sizing, now that we have the vacancies and there might be some opportunity for growth, there's still the issue of the remote worker and the hybrid worker. And what burden does that place on businesses and developers?
On the Bellworks development, the former AT&T campus, it's making progress, right? They've signed a few leases, a few large leases. They have a couple million square feet there. Yeah. They have a long way to go. And people have read about their project in New Jersey. It was amazingly successful. It was very much the same formula. They took the same AT&T campus and they chipped away at it. And they did 1,000 square foot lease and they did 100,000 square foot lease. And they just became the destination. And so I think they're still in the early stages of that, realizing what that development could become. I think they'll continue to chip away at it. I toured it just a few months ago with a client of mine, and it's impressive. They love it, and I think it'll continue to be attractive because companies want a place that's vibrant, right? And if you're in a building where the anchor tenant in the building isn't there, guess what? You don't really want to be there either if they're not there. I was in an elevator the other day, and a company had was out looking in market options in the Naperville-Lisle area, and they said, we share space with this engineering firm who's never there, and their leadership wants everybody to come back, but they're afraid they're going to lose everybody. And that's directly tied to the job market. The fact that we haven't had a real jobs recession means that companies that want people back really are having a hard time doing it in a meaningful way. They might be able to say, yeah, one day a week we'd like you, or some of them are 2 or 3 days a week. But in order to get 4 or 5 days a week, they're just not able to do that. And so I think those companies that are in those sort of half-empty buildings are going to want out, and they're going to be attracted to the buildings that have, for lack of a better word, a real vibe. They want to be in buildings where there's other people. They want to be in spaces that are full of people.
Mark, not as easy to be remote/hybrid in the industrial world or the distribution or manufacturing world?
Yeah, correct. In our world, it's not as nearly as much of an issue. We do run into, I've got a number of listings right now where there was a heavy office build out in an industrial space. The tenant moved out. Now we're trying to market it as vacant space. And in a lot of cases, it's the owner of the building wants to wait and see. And, we tell them that's fine, but the chances of another company coming along and needing 30,000 square feet of office and a 300,000 square foot distribution space is slim to none. And in one case, well, actually in 2 cases right now, the landlord has come to the conclusion we need to tear this out and just get ready for the new tenant who needs 5,000 square feet. I mean, that's just the reality, and it's easier to do on the industrial side certainly than it is the office side, but it's something that has to be done.
You guys mentioned submarkets a lot. So again, for our listeners, and we think of DuPage County and being in economic development, I understand the east-west corridor versus the O'Hare market, whether it's anchor shopping malls, whether it's anchor office developments, whether it's anchor industrial warehousing and distribution facilities. Are there certain submarkets that are outperforming other submarkets?
Yeah, on the industrial side, I-88 has done pretty well, obviously right in the center of the county. I-55, the Bolingbrook, Romeoville, Woodridge, that has historically been a huge distribution market and continues to be so. And then obviously we've seen a lot of development that's pushed down to I-80. And, with the intermodals down there, that's always a draw, will continue to be a draw for a lot of these companies with the rail coming in, UP and BNSF. So that's continued to be the large distribution areas that we focus on.
What about from an office perspective?
From an office market perspective, we track things statistically by the submarket. So we would call the east-west corridor, Oak Brook to Aurora. But the reality is that's a pretty long stretch.
Sure is.
And so it's not fair to say, well, this is what's happening in the East-West corridor. I think another way to look at it is to think about Chicago in concentric rings. In other words, the closer you are to Chicago, like Oak Brook, O'Hare, maybe Northbrook, those are areas that are faring pretty well. And it's because of their access to the airports, their access to public transportation, access to trains, access to the Oak Brook Mall or those types of amenities. Those tend to be doing better than the other ones who are further out, further removed, further on the 90 tollway, further on 294. Those are, as we expanded further west, further north, further northwest, those developments tended to be much larger. That's where you had some of your mega Sears campuses. Those are markets that are struggling probably a little bit more than the inner circle is.
So I know we only have 4 or 5 months left in 2024, but at our Choose DuPage Regional Business Outlook event, which I know you guys attend on a regular basis, and we always thank you for that, we toyed with the idea of a theme this year of do more in 24 or thrive in 25. 24 is kind of behind us. So from a real estate perspective, here comes the prediction component of it. Are we going to thrive in 25, or do we try to stay alive in 25 and get our kicks in 26 or whatever other rhyming saying our great marketing people can come up with?
I would say, just obviously focused on the industrial side, I think we're waiting for the election to get past the election, regardless of who wins, so that there's that uncertainty's out of the way, and then interest rate cuts, because we keep hearing, particularly on our side of the business, all this capital that's been sitting on the sidelines that wants to buy industrial but has not because of the things we talked about earlier, and waiting for some normalcy and waiting for some data points for some portfolios to sell. So I think that once interest rates start to go down and that spread starts to make more sense between what someone can buy a building for and what they can sell it for, I think that we're going to see activity pick up there, which then will spur speculative development, which we have not seen on the industrial side. When that happens, then there'll be more options for tenants and rental rates will start to stabilize a little bit, and I think that's all positive. So I think 25 is going to be a good year.
Okay, so I got to put the screws to you a little bit more on that one, my friend. Recognizing you're not an economist, not holding you to anything, although we do record these. So
sure.
What is that magic number for interest rates? How many cuts is your market looking for? Is there a number that says we're not doing anything until we get back to 5? Or
no, for me, it's more, I think, in my opinion, it's more interest rates are coming back down. It's a perception more than it is a number. Once interest rates start coming down, I think most feel like they're not going to jump back up again anytime soon.
And they're not going to go to 3 again.
And they're not going to go to 3. But once they see that trend start, I read an article where they said none of these money managers who with money sitting on the sidelines getting into real estate, they're not paid to be the first ones to jump in. It doesn't make any sense. They don't want to be the first risk taker. It's too much risk for them. But once you see a few jump in, then they all jump in. So I think it's more a trend of let's see interest rates start to trend down. Okay, things are going in the right direction. We've got all this money sitting on the sidelines. Let's get back into real estate. I think that's the way I see it.
So you're a thrive in 25 guy.
For sure.
Okay. Maybe that's more of a high 5 in 25.
Okay, I like that.
I don't know if we're going to thrive in 25. And I don't know that we're necessarily on the office side trying to survive. I think we're still evolving. I don't have a rhyme that goes with evolving or any of that. But I do think I mentioned how many companies that we see in the marketplace. I think that they're moving kind of slow because they are kind of waiting. They want to wait and see. And I think once they have sight lines and they view that as positive, we'll continue to move and we'll continue to get better. I do think the worst of it is behind us. I think that there's going to be a continued sort of right sizing with office groups. I also think there's going to be a continued reduction of inventory and a stabilization of vacancy to some degree. And overall, I think the vibe should stay positive in 25 for sure. I think we're on a forward positive trend.
And I did want to add, I've got land in West Chicago at the DuPage Business Center. So as this development starts picking up again, we're open for business.
How many properties are left out there, Mark?
So we have 4 sites that are between, call it 20 and 50 acres. So we can do a 50-acre contiguous piece, and then we have a number of 20-ish acre sites that are available. So we can do a number of sizable developments still in the park.
And how many developments kind of to date have completed? Because you and I remember the days when it was 2 buildings out there.
Yeah, I mean, I think we've sold roughly 400 acres in the park, and there's been about 4 million feet of development total in the park over the last 6 years. So we've certainly seen it slow down a little bit the last couple of years based on what we talked about earlier, but I think it'll be back as soon as development comes back.
Any closing thoughts about kind of DuPage, this region, if we're going to start to see an uptick in 25, if we're stabilizing in the market, what do we need to do as a county? We talked about GSEP on our last program. GSEP, as you guys know, is the Greater Chicagoland Economic Partnership. It's off and running. We're 18 months into it. We're showing successes everywhere. I'm hearing people talk about, my goodness, the Chicago market finally got its act together from a real estate perspective. Is there anything specific that you can relay to me that I can take to our board, that I can take to the county board and say, if we can continue to focus on this, or if we could do this, or if we could eliminate that, we'd really continue to position ourselves as a premier global business location?
I will say that when I look at how many inquiries we have that have come through your office on the park in particular, when you've got new companies, new RFIs, I mean, I used to maybe get 1 or 2 every couple months that I would talk to your staff about. Now it's, it could be 2 a week. So I think that better than me, but that may be a direct result of what you're doing on the
We're trying to get the marketing, right?
Yeah.
I mean, we're trying to communicate and use social media and everything we can to get those deals done. So that's good to hear.
Yeah, no, it's great. I mean, it's a numbers game, right? And we're not going to win all of them, but we're certainly getting seemingly more attempts than we ever have in the past. So that's great.
And I would just say, honestly, nothing specific, but keep celebrating the successes that DuPage has and that the region has, and because they do apply to the successes that happen in downtown with the quantum deal that we talked about. It matters to DuPage. It matters to us. It will attract those like-minded firms that want to be a part of that growth, and they are located here, and we have the talent here for sure. We're a very diverse community, and that allows us to grow in a lot of different ways. And so we just need to keep growing and and not remain stagnant.
Right.
Because thinking about the ways that we used to do things, we need to think about the ways that we can do things and keep celebrating those successes.
Well, that's a great note to finish on. So that's it for today's show. Mark and Jim, thanks so much for joining me. Again, you guys are great. We really appreciate everything you do for DuPage County. We appreciate everything you do for Choose DuPage.
Thanks.
Thank you very much.
And as always, thank you to the College of DuPage for supporting today's episode. To keep up with what's happening in DuPage County and the Chicagoland region, follow Choose DuPage on social media or visit choosedupage.com. I'm Greg Bedalov. Thanks for listening, and we'll see you next time on the DuPage Business Beat.